Hi everyone, welcome to my channel. Today we'll be doing a deep dive into one of the most critical processes in any company, and that is the order to cash or O2C cycle. So what is O2C? O2C is the journey of a company from the time it receives an order from the customer till it delivers the product, sends the invoice, and ultimately collects the payment. It may sound straightforward, but it is not. There are a lot of hidden risks, and if they are not managed properly, it can result in loss of revenue, delayed cash inflows, or even fraud. So in today's video, we will be covering the different sub-processes in O2C, right from customer master data management, order processing, credit management, and so on. We will be seeing the risks in each sub-process and understand what we can do as an auditor to mitigate these risks and add value to the company we are auditing. So let's start with the first sub-process, which is the customer master data management. Now, customer master data, like the name says, is the database of all the customer details. It includes the customer's legal name, the billing or shipping address, tax information, like say GST number, PAN number, then the credit terms, like say net 30 days or prepaid, then contact details, for example, email ID, phone number, address, name of the key persons, bank account details for processing any refunds or payments, preferred currency for transactions, and so on. Now, why is this data so important? Because it is used throughout your O2C cycle. It is used for generating invoices, for shipping products, for collecting receipts. So that is why it is very critical to have a complete and accurate customer master data so that there are no problems downstream. So the key risk when it comes to customer master data is unauthorized or inappropriate creation or modification of the master data. So to simplify it, let's take an example where say if the billing address is incorrectly entered in the customer master data, then there's a possibility that the invoice will be sent to the wrong address. And then because the customer has not received the invoice, there could be a risk of not receiving the payment from the customer. Similarly, if the tax identifier like the GST or PAN is incorrectly entered in the master data, then that could result in tax or compliance issues. Another thing, we said that the data must be authorized. So the person who's creating the records must be authorized to do so and must do so after proper verification of the KYC documents of the customer. And this is to avoid any scenario of having a dummy record or fake records and then later having fake invoices and inflated revenues in the books of account. So as an auditor, what you can check is firstly, segregation of duties. That is, the same person should not be able to create and approve the customer master record. There should be a segregation to allow for proper verification and a maker-checker mechanism. Similarly, the same person should not be able to modify and approve the record. Second, you can validate if the system enforces certain mandatory fields and also defines the format in which those fields can be entered. For example, fields like GST, PAN can be made mandatory. And also, we all know that the PAN number is a 10-digit alphanumeric field. So you can check whether the system will throw an error if I just enter, say, a numeric field or just enter it as ABC. You can check whether there are any controls to prevent or detect duplicates in the customer master data. A preventive control could very well be a system control that throws an error if there is a near match between the customer name or any identifier. A detective control could be a report that is periodically monitored to check if there are any potential duplicates. And lastly, you can also check if there's any periodic review of the customer master data to filter out any inactive or stale customer master details, and also check if there are appropriate history logs and change logs to capture who has made changes to the master data and what field has been changed. So if you see, the risks in the customer master data management are very similar to the risks which we saw in the vendor master data management when we covered the audit of purchases or audit of procure to pay cycle. And I have a video there where I have explained all the sub processes in P2P, the key risks therein, and what you can check as an auditor. So if you have not watched that, I highly recommend you watch it because it will be very helpful for you when you're doing your P2P audits. Now, coming back to the O2C process, let's move on to the next sub-process, which is credit management. Now, imagine you own a store and a customer comes to you and says, "Hey, I would like to buy this from you, but I cannot pay you now. I will pay you later, I promise." So if you agree to this, you are giving credit to the customer. Now, managing who gets credit, how much, and when they pay back is nothing but credit management. Now, why is credit management so important? Because if the customers don't pay you on time or don't pay you at all, then you will run out of cash and you will be in losses, and that could severely impact your business. So coming to the key risks in credit management, firstly, not having credit checks in place. So imagine you extend credit to anybody without doing any background verification. Then it's like lending money to someone who doesn't even have a job to ensure they will repay you on time. Second is violation of the credit limits. Say you have assessed that a credit limit of 50,000 is suitable for a customer. But if the same customer is placing an order worth 1 lakh, then there's a risk that there could be a potential bad debt or loss if the customer fails to repay that amount. Third, lack of a well-defined approval process. If anybody in the team can extend credit, then that is a big risk. Fourth, lack of periodic review. Imagine a company was very strong financially in 2024, but this year it is not as strong financially and has incurred losses. So you cannot have the same credit limit which you had last year in the current year, and this calls for a periodic evaluation of all customers' credit limits. So what you can check as an auditor is what is the mechanism for granting credit to a customer? Is there a defined credit policy? Is there a defined approval mechanism? And what sort of information is checked before granting the credit limits to the customer and how they are defined? You can also check if there's any insurance taken. Some companies take insurance to protect against such losses. And you can also evaluate if there are periodic reviews. And there's also a functionality called credit blocking, wherein the system automatically blocks a sales order from being processed if the customer has exhausted its existing credit limit. So that's also a very good check, and if it's not there, then you can recommend your client to have that in place. So the next step is order processing. So what happens here? A customer will place an order, and then the sales team of the company will review if the customer is valid, if the credit limit is appropriate, whether the stock is available, whether the product price and discount are up to date and accurate, whether the terms and conditions are accurate, and then they will accept the order and confirm the order and enter that into SAP or ERP. So that is called order processing. So what are some of the risks in order processing? Firstly, accepting orders without doing a creditworthiness or KYC check. That can result in risk of bad debts and potential losses. Second, there could be an incorrect order entered into the system or a duplicate order in the system, both of which can cause excess shipments and customer disputes and loss of revenue. Third, if an order is accepted without even checking the product availability, then there's a risk that there could be a delay in shipment or that the order may not be fulfilled, which can ruin the customer experience and expose your business to reputational risk. Fourth, unauthorized or incorrect discounts or product prices. These can again result in loss of revenue. There could also be a risk that the pricing is inconsistent. For example, the same product may be sold to one customer at 1,000 rupees and to the other customer at 950 rupees. And that is why it's important to do some analytical checks here to identify why preferential treatment is given to certain customers. Is that in line with what the business strategy is and whether it is appropriately authorized? Fifth, there could be a risk that the orders are being processed against expired or invalid contracts, which can again result in legal disputes. So as an auditor, what you can check is whether there are credit checks integrated in the system so that the system is automatically checking the credit limit before accepting the orders. Second, is the stock availability being checked in real time before accepting the order? Third, you can look for pricing and discount related controls. That is, who has the authority to approve changes in prices or approve or grant discounts. And you can also check whether there's a well-defined pricing and discount policy in place. Fourth, you can also look for segregation of duties. That is, the person who is creating the order in SAP should not be able to approve the order in SAP. Fifth, you can look for controls in place in the system to identify or flag potentially duplicate sales orders. You can also do an analytical review of all the sales orders during your audit period to identify if there are any duplicates. You can also do a trend analysis in terms of prices to see if the prices are consistent across different customers or if excessive discounts have been granted to a particular customer to identify any potential red flags. You can also check if the system is pulling information from valid contracts, if there's any mechanism to periodically review and update the contracts. So the next sub-process is order shipping and fulfillment. So what happens here? Once the order is accepted by the sales team, the warehouse receives the order and they will then pick the items from the inventory, pack them securely, and then generate the delivery documents and shipping documents and ultimately dispatch the goods either through the logistics partner or through the company's in-house transport fleet. Now, why is this so important? Now imagine there's a huge company dealing with a lot of customers and they end up accidentally mixing up the customer codes. So what happens? The shipment which needed to be sent to A got sent to customer B. So both the customers are now unhappy. There could be sales returns and loss of revenue and also loss of reputation. And that is why it's essential to have appropriate controls in the shipping and fulfillment process to mitigate such risks. So what are some of the risks in this sub-process? First, like we already saw, shipping to the wrong address. Second, shipping the wrong product or the wrong quantity. Third, shipping damaged goods. Fourth, shipping without generating delivery documents. Now this is important, otherwise in future if there are disputes, it can result in legal complications. And lastly, shipping but not updating the stock real time in SAP. So here are some things that you can check as an auditor. Firstly, is there a three-way match which is driven by the system to reconcile the quantity and value between the sales order and the delivery note? Second, what is the process for generating delivery documents and receiving customer confirmation? Third, you can check whether the shipping address is being pulled directly from the customer master to avoid any manual intervention and any risk of incorrect delivery. Lastly, you can check if the inventory syncing is done automatically. That is, as soon as the goods are being dispatched, then whether the inventory is being updated real time. If not, how it is being updated, at what frequency, and who reviews it. And also you can look at the trend of open orders or if there's a delay in shipment. So that's kind of the analytical aspect that you can also review based on the data you obtain for the audit period.